Thank you, Christy, for walking us through all of those housekeeping items. So I am Olivia Crouch, and I have Deborah Burleson here with me to teach you all about leases. So as Christy said, we have a lot of information to go through, so let's get started. So first off, I wanted to remind everyone that we have a leases project page on our website. Christy, can you move to the next slide, please? Thank you. So this is under the BARS and annual filing section, and that page has a lot of information about leases, so be sure to check it out. So you might have noticed we've been talking about leases for a couple years now, and that's because this was originally supposed to be effective back in 2020. However, due to COVID, the implementation was pushed back to fiscal years ending on June 30th, 2022 and later. So governments that follow the calendar year end, lease accounting is applicable for you in your fiscal year ending December 31st, 2022. But you don't want to wait until the end of 2022 to implement this because you need to start coding your lease payments appropriately starting January 1st, 2022, and that's only a few months away. So hopefully this training will prepare you for what you need to do to get your government ready. Next slide, Christy. So with this new lease accounting, this is a conceptual change for how we think about leases. And now we're thinking of leases as a financing of the right to use an asset. And since we're now financing something, it's treated similar to debt, which means leases are going to be reported on your Schedule 9 or your Schedule of Liabilities. And we'll get to that later. But first, we're going to break down the definition of a lease. And this part is really important so that you know what this guidance applies to. So the term lease is widely used, but we need to evaluate contracts based on their substance, not on their label. So you might have some contracts that are not called a lease, but that meet this definition. And in that case, it needs to be treated like a lease for your accounting and reporting. So here's our definition. It's a contract that conveys control of the right to use another entity's non-financial asset, which is a capital asset basically, as specified in the contract for a period of time in an exchange or exchange-like transaction. So I know on the first read that might be a little bit confusing, so we're going to break down the definition and talk about what this actually means. Well, the first piece we're going to focus on is the word contract. Now, a contract might not be written, but it should be legally enforceable. However, if you have any contracts or agreements that are not written, I really encourage you to work on getting those written down. Another thing to consider is that a lease might be a part of some larger contract that has several components. And the component of that contract that meets the lease definition should be treated like a lease. Our next key piece of the definition is control of the right to use an asset. So again, this applies to capital assets, but not services. And this is different from the asset itself. So when you lease something, you have the right to use that asset or a comparable one, but not necessarily the asset itself. And this control criteria has two aspects. There's the right to obtain the present service capacity from that asset. And basically that just means you get to use the asset. So if you think of a building lease, if you're occupying the building or using the space, you're getting the service capacity of that building. And the second part of control is the right to determine the nature and manner of its use. And this is within the confines of the contract. So if you're leasing a building and the contract says you're not allowed to make structural changes like add a wall or tear down a wall, that doesn't mean you don't have control of the building while you lease it. You still have control within the confines of your contract. So now I'll let Deb walk us through some examples to help us understand what is and is not a lease.
All right, let's have a knowledge check here. They have a multi-year agreement for portable toilets that allows the vendor to switch out the assets as necessary with comparable assets. And this substitution is made several times per year. So different assets. Is this a lease? What do you think? Okay, next slide. Yes, you see the right to use the underlying asset is distinct from the asset itself. Substitution of an essentially identical asset doesn't change control of your right to use it. Here's another one. Now, a city has a multi-year agreement for exclusive use of a facility during regular business hours. In the evenings, a yoga instructor uses the facility, and on Sundays, a church uses the facility. So does the city have control of use? Think about that for a minute. Okay, let's go. Yes, you see, control doesn't have to be uninterrupted. Here's one more. A city has a multi-year agreement with an individual that allows goats to graze in a city park year-round. The agreement doesn't allow the activity to impede others' use of the park. So the goat herder couldn't say, okay, everybody playing Frisbee, get out of the park. Now, is this a lease? Okay, let's see. No, see, that individual, the goat herder, does not have control of the underlying asset, which is the land. This is actually a grazing rights thing. Now, here's our first code word. Remember, you have to have these in order. The first code word is leases.
Okay, moving along with our definition again. So this time we're going to focus on another entities. So by another entity, we just mean that this does not include any interdepartmental leases. So if you have an internal service fund that leases out equipment to other departments or other funds, that does not need to be reported as a lease liability on your Schedule 9. So the definition also specifies a non-financial asset. And that basically just means a capital asset. So buildings, vehicles, copiers, equipment, that kind of thing. And the arrangement must be exchange or exchange-like. And that just means that there's relatively equal value exchanged. It doesn't have to be exactly equal. So if the going rate for an office space is $1,500 a month, but you only pay $1,300, that's still exchange-like. I also want to mention that non-cash does not necessarily mean non-exchange. So I'll give you an example to let you know what I mean here. So there's a library district that's located right next to a city. And this library has a huge parking garage, and the city needed extra parking spaces on court day. So the library said, okay, city, we'll give you 15 or 16 of our parking spaces if you let us use some of your office space. So in this case, the library is leasing out their parking lot to the city, and they're leasing office space from the city. So that's a non-cash exchange, but it is an exchange-like transaction. So right now, we don't have a ton of examples on this. So if your government is involved in some sort of non-cash lease arrangement, reach out and let us know so that we can help you analyze it and give you some guidance for the accounting and reporting that would go along with it. But I'll turn it back over to Deb for another example.
Okay. A school district pays $10 a year to use a field owned by a city. The school district has exclusive use of the land for its various sports activities. The school district maintains the lawn and has placed a portable building on the land to store equipment. So clearly, the school district has control of the right of use. But is this a lease that will be reported on your Schedule 9? Remember, we're thinking, is this an exchange transaction? Slide. No, you see, because it's not an exchange transaction. It has all the other qualities of a lease, but it's not an exchange transaction because it's only $10 a year.
All right, back to our definition. So this next piece is that the lease has to be for a period of time, meaning it's not indefinite. And that brings us to another really important topic, which is the lease term. So how long is the lease? And you need to know this because your total lease liability that gets reported on your Schedule 9, you have to know how many payments you're going to be making. So you need to know that lease term. So what actually gets included in this lease term? Well, the first bullet point there is fairly easy. We're going to include any non-cancelable periods. But a lot of contracts also include additional clauses about extending or terminating the contract. So what about those? Do we include them or do we not? Well, when we're talking about extending the lease, if the lessee or the lessor has the option to extend the lease, then you include that term in your lease term if you're reasonably certain it will be exercised. Now, reasonably certain doesn't mean absolute certainty, and it's going to involve some professional judgment. So you'll need to consider your government's facts and circumstances to help determine whether or not it's reasonably certain. So talking about lease terminations, if the lease agreement has the option for either the lessee or the lessor to terminate the lease, and you're reasonably certain that option will not be exercised, so you're reasonably certain that lease won't be terminated, then you'll include that period in your lease term as well. And you've probably noticed the emphasis on those last two bullets. And that's because those pieces are only included in the lease term if the lessee or the lessor has the option. But if both parties have the option to terminate, or if both parties have to agree to extend the lease, that's not included, even if you're reasonably certain. So that's called the cancelable period, which is not included in our lease term. So I'll let Deb walk us through some examples of how to determine our lease term.
Okay, let's figure out the lease term on this one. A county leases office space at full market value to various nonprofit agencies in support of their programs. The lease terms are for 5 years, and either party can cancel after the first 6 months with 30 days notice. So what is the lease term? Okay, what is it? It's only 6 months, you see, because both parties each have the option to terminate after the initial non-cancelable period of 6 months. You might think they're going to go on for 5 years, but the term is 6 months. Here's another one. A lease has an initial non-cancelable term of 5 years. After that, the lease will continue on a month-to-month basis, and both the lessor and lessee have the option to cancel with 30 days notice. Now, the lessee has operated a successful enterprise at this location for years and plans on selling it at a significant gain when he retires in 7 years. So what is the lease term? Okay, let's see. It's only 5 years. Regardless of probability, when you're looking at the lease term, you're just looking at the form of the contract. In this case, it's 5 years.
Okay, now we have some good news. There are a few exclusions for items that are not considered leases, meaning you don't report them on your Schedule 9. And the first one is a short-term lease. And that's when the maximum possible term of your lease is 12 months or less from the beginning of the lease. Now, I really want to stress this is maximum possible term. So that includes all options to extend, regardless of the probability of whether it will be extended or not. It's based on the form of the agreement, not the probabilities. So the determination of the lease term and whether something is a short-term lease are two different things. So first, start by determining whether it's a short-term lease or not. And remember to include all those options to extend, regardless of whether you think it will be exercised or not. And if you determine it's a short-term lease, then you're done. But if you determine it's not a short-term lease, then you move on to determining that lease term. And that's where you use your professional judgment to determine whether it's reasonably certain those options will be exercised. So Deb has another example for us.
Okay. A lease has an initial non-cancelable term of 6 months with 5 options for the lessee to extend for 12 months at a time. The lessee is a startup company, and it's really unlikely these options will be exercised. So is this a short-term lease? Yes or no? Okay, let's see. No. See, the maximum possible term, regardless of probability, is 5.5 years. And interestingly enough, the lease term for accounting purposes, which is based on probabilities, is only 6 months.
So as you might know, if you have a contract that transfers the title of the asset to your government at the end of the lease, that's what was previously called a capital lease. And capital leases are currently reported on your Schedule 9, or they should be. So capital leases are now going to be called installment purchases. And installment purchases are still reported on your Schedule 9, but it's just in a different category as leases. And we'll show you that soon. Now, if a lease contains a purchase option or a bargain purchase option, you need to determine whether your government is going to exercise that option or not. If you're not exercising the option, treat it like a lease. If you are buying the asset at the end of the lease, then treat it like an installment purchase. And again, we'll show you that coding and reporting difference soon.
Here's another example. A municipal golf course leases golf carts under a 3-year lease agreement and will own the golf carts at the end of the lease term, unless it exercises its option to terminate the agreement, which it may do at any time. So is this a lease or an installment sale? Okay, what is it? It's a lease. Now see, if there was no option to terminate, it would be an installment sale. Here's our next code word, well, code number, let's say, 2022, 2022, the year, the reporting year that you're going to implement these new lease standards. So number 2, 2022.
Okay, a few more items that are not considered leases for accounting and reporting purposes include leases of intangible assets like patents and software, although there is some new accounting guidance specifically for software that's going to be effective in later years, so just keep an ear out for those. And then leases of biological assets. So for example, animals at zoos can be leased from other entities, and the animals are biological assets. But those are excluded from this because it's hard to determine the lease term when that underlying asset could die at any time. So don't include those. And then leases of inventory that's held for resale and service concession arrangements are also excluded. And back to Deb for another example.
Okay. Now, a county leases land to a farmer who has exclusive use of the land to grow crops. So is this a lease that you would report on your Schedule 9? What do we think? Yes, it's the land that's the underlying asset, not the crops. And this was a mistake that we initially made. Also, someone said, oh, all those leases to farmers in this county, we don't have to worry about those. But no, it's the land that is being leased, and land is a capital asset.
So a few other things that you should not report as leases include any assets that's financed with conduit debts, and that's debt that your government has issued on behalf of someone else, and any supply contracts like power purchase agreements that do not give the government the right to use the underlying asset. So remember, the leases are all about using some underlying capital asset. And then you're also going to exclude regulated leases, like leases between an airline and an airport. So that's like a lease between American Airline and like SeaTac. The liability you report on the Schedule 9 is going to be the total amount of future lease payments. So whatever your payment amount is per the contract, multiplied by the number of payments you're going to make. And the number of payments you're going to make is directly related to the lease term that we've been talking about. So you figure out your lease term to know how many payments you're going to make, and then multiply that by your payment amount. Now, at the inception of the lease, this is only reported on your Schedule 9. You're not going to make any accounting entries for your Schedule 1 at the beginning of the lease. And that's because in your typical lease, you're not exchanging any cash up front, so there's nothing to report on the Schedule 1. But what does go on your Schedule 1 are the cash payments that you make throughout the lease. Now, recording the leases on the Schedule 9 requires making some assumptions. But what do we do when those assumptions change? Well, we need to remeasure the lease liability, which is basically just saying recalculate it. So if there's a change in your lease term, for example, you originally thought you would not exercise an option to extend the lease, but then you decide now you are going to exercise that option to extend, well, you need to recalculate the lease liability to include that additional time. And if you change whether or not you're going to exercise a purchase option, then you need to recalculate it. And we have an example on this one later on. Also, if there's any change in any of the estimated amounts that you use to calculate your lease liability, then you should recalculate that liability using your new amounts. And our last one here is to recalculate your lease liability if you've resolved a contingency for variable payments. Now, we haven't talked about variable payments yet, but an example of that is if you're renting a booth at a farmer's market and you pay $100 a month plus 10% of your gross profit. Well, that 10% of your gross profit, that's a variable payment. When you calculate your lease liability, you're only going to include that fixed amount. But if you have a variable payment that's based on some contingency, and that contingency becomes resolved, which in effect makes the rest of those variable payments become fixed payments. So now you know for sure what those payments are going to be for the rest of your lease. Then you recalculate your lease liability using those known amounts. So here's the BARS coding for your lease payments. So as the lessee, meaning you're paying someone else for their asset, as you make payments, you'll use BARS code 591 with object code 70. And those P's, those two P's in the middle, stand for prescribed numbers, meaning that there's specific numbers that should go there that's based on the function of the activity. So take a look at your chart of accounts to determine the correct numbers that go there. And then as the lessor, meaning you're leasing something else out to someone else, your revenue receipts will be coded either to a 340 code or to 362. So if you think back to your chart of accounts, a 340 is a charge for service code. And you're going to use this code when leasing is the primary function of that fund. And this determination is made by fund. So if you have a fund whose primary operation is leasing assets to other governments or other citizens, then use a 340 code. But you might have a different fund, like your general fund, whose primary purpose is not to lease out assets. And in that situation, you would use the 362 code. And then for installment purchases, so where you're going to own the asset at the end of the arrangement, you'll use BARS code 594, which is a capital expenditure code. Now you might be asking, why do installment purchases use the 594, but the leases use a 591, which is a debt service code? And that's because an installment purchase, where you own the asset at the end, what you've essentially done is bought the asset just over a period of time instead of all at once. So the nature of your transaction is more like purchasing a capital asset. So you use those capital expenditure codes. But if we think back to the beginning of the training, where I said there's a conceptual change in how we think about leases, and now we think of them as financing the right to use a capital asset, it's a financing. So that's why we're using our debt service codes, that 591. Now you also need to know what the codes are for your Schedule 9 or your Schedule Liabilities reporting. And we have 4 codes here. So the first one, 26351, is for general obligation debt for installment purchases. And again, that's where you plan to buy the asset at the end of the arrangement. Now this is also the code that was formerly used for capital leases. And capital leases were only reported on your Schedule 9, where the government would own the asset at the end of the year. So really, if you're already reporting something in this code, that means you should be planning to buy it, and you can keep the code the same. The only change here is that instead of calling it a capital lease, you'll call it an installment purchase. Our second code is the 26352, and that's the revenue in non-general obligation installment purchases code. So the difference between the first code and this one is just the classification of whether it's general obligation debt or not. And general obligation debt is that which you've pledged the full faith and credit of your government. So that might not be super common for lease arrangements, but you might have them. Now our last 2 codes are for leases, and these are brand new codes. So the 26356 is the general obligation lease. So leasing arrangements where you do not plan to own the asset at the end of the arrangement. And these were not previously reported on your Schedule 9, but now they are. And then the 26357 is just the revenue and non-general obligation debt code for lease arrangements. So in addition to reporting on the Schedule 9, lessees will have to make some note disclosures. So in here, you'll need to include a general description of the leasing arrangement. So that's things like types of asset lease, the lease term, how much the payments are. And for this, you can group your leases for disclosure purposes. And what I mean by that is if you have a ton of leases, it will really clutter up your notes to list every lease individually. So instead, consider logical groupings, like making disclosures by the type of asset leased. So have a general description of all your land leases, and then a separate description that describes all of your vehicle leases. Or let's say you only lease vehicles, but they all have really different terms, then you can consider grouping the assets by the ones that have similar terms. The other really important thing, and this one should be familiar because you do it for debt, and this is to list your lease payment amounts for each of the next 5 years, and then in 5-year increments after that. And then finally, include any commitments for leases before the lease term begins. So that would be things like if you have to make a big payment before the official start of your lease term. Let's take a look at an example of a note disclosure. So this is on our leases project page on our website, so you can access this there as well. But here it just says a city leases land and buildings from the state for $500 a month under lease arrangements that range from 10 to 20 years. The leases began in January 2015 and they'll end in December 2035. And they include options to cancel after the first 10 years. So as you can see, they just grouped all of their land and building leases into one general description, but they still included the important terms of the leases. And then they also list the total amount paid in 2020, and then they have their future lease payments in that table below.
Okay, here's our third code word, project. Project as in Lisa's project page and bars, right? So project is your third word.
Okay, now we're going to take a look at some examples and how to report them on the Schedule 9. So on this slide here, we have 3 lease examples, and we'll walk through each of them. So our first one, the government is leasing a building for a monthly payment of $1,500. The lease is for 10 years, and it started back January 1st, 2016. Our second one is your government leases copiers for a monthly payment of $300 plus a 1-cent charge per copy made. This lease is for 2 years with an option to extend the lease for another 2-year period. You determine it's reasonably certain your government will extend the lease. So maybe your government always extends this lease, so you're pretty sure you're going to do it this time. But to make that determination, you just look at your own government's facts and circumstances. And the first payment for this one starts on July 1st, 2022. And our last one, your government leases an excavator with a monthly payment of $2,000. The lease is for 3 years with an option to purchase the machine at the end of the lease for $3,000. The government's leasing the excavator for a one-time project, so they do not intend to buy the equipment at the end of the lease. The first payment is made January 1st, 2022. So now let's take a look at the example Schedule 9. So again, this is for fiscal year ended December 31st, 2022. And that's the first year you're going to be reporting leases on your Schedule 9. So we're going to first focus on the building. And this building lease started way back in 2016, which means as of January 1st, 2022, this lease was already in effect, and there's a beginning balance to report on this Schedule 9. So we know that the end date of this lease is 2025 because it was a 10-year total lease. So at the beginning of 2022, the government still had 4 full years of payments on the lease left. So to determine that beginning balance, we took the monthly payment of $1,500 and multiplied it by 48 months to get that $72,000. And then the lease reductions are just the monthly payments that were made in 2022. So just our $1,500 monthly payment multiplied by the 12 months. So for all of the leases that you have, you'll need to figure out what the beginning balance is to report on your 2022 Schedule 9. And that's just the total amount of payments left as of January 1st, 2022. So now let's talk about the copiers. So the copier lease started in 2022, so we don't have any beginning balance. And for the additions, we know that the monthly payment is $300 and there's a 1-cent charge per copy. Well, good news, we ignore that 1 cent. That's what we call a variable payment, and it's not factored into our calculation here. Now, we need to know how many months this lease is going to last. And as of the end of 2022, our government expected to exercise their option to extend the lease. So that means our lease term is 4 years, the original 2 years plus that 2-year extension. So that's why our due date is 6/30/2026. And to figure out the total additions, we multiply our monthly payment of $300 by the 48 months to get $14,400. And then for our reductions, in this case, our monthly payment started in July, so we only made 6 months of payments. So that $1,800 is just our $300 monthly payment multiplied by our 6 payments we made. So our last lease is the excavator. And again, this lease started in 2022, so we don't have a beginning balance. And the additions amount is just our monthly payment of $2,000 multiplied by 36 months because it's a 3-year lease. There were no options to extend, so determining the lease term was pretty easy here. Now notice we did not include the $3,000 purchase price because as of 2022, we are not planning to buy the equipment. We only need it for the one project, so we're not buying it. So the additions here only include the monthly payments. And then our reductions there, that's just the 12 months of payments that we made in 2022. So the first year seemed pretty straightforward, but in the next fiscal year, we learned some new information. So our first one here, there's another copier company that can give us a better deal. So we originally thought we'd exercise our option to extend the current lease for 2 years, making the total lease term 4 years. But now we're going to go with this new company when our 2-year term is up. So in other words, our lease term has changed. And we also learned that our Public Works Department has another project that they need the excavator for. So now it's a way better deal for them to exercise that bargain purchase option and buy the excavator so that they can continue using it on their next big project. So now we're going to exercise that purchase option. Now, both of these events trigger what we call a remeasurement. So again, that just means we have to recalculate our lease liability because as it's currently reported on our Schedule 9, it no longer lines up with our expectations. So let's take a look at the 2023 Schedule 9. Again, we'll start with the building. And on this one, nothing special happened here. Another year passed. We made all 12 of our $1,500 payments. So we just reduce our liability by $18,000 and move on. Next are our copiers. So there was a change here. We originally thought we'd lease them until 2026, but now that we are not exercising our 2-year extension option, the lease will actually end in 2024. So we updated the due date here. Now the beginning balance is just the same as our 2022 ending balance of $12,600. And now for the reduction amount. This is made up of 2 separate pieces. So the first piece, we continue to make our monthly payments. So 300 times 12. So our liability went down by $3,600 for the monthly payments that we made. But now we're not going to make those additional 2 years of payments that we originally thought we were. So we have to get rid of those as well. So we're going to take that 300 monthly payment, multiply it by the 24 months for those 2 years that we're removing from our lease term, and that gives us $7,200. So our total reduction is the $10,800. Now the ending balance is just our beginning balance minus the reductions, but we can double check that we're reporting the correct amount here by making sure the ending balance equals the remaining amount of payments that we expect to make. So as of the end of 2023, we expect to only make 6 more months of payments. And we can tell that our ending balance of $1,800 is just 6 months of payments of $300. So one thing I want to point out here is that our filing system, so when you file online, it compares the total reductions on your Schedule 9 to the total debt payments reported on your Schedule 1. So if you have a reduction to your lease liability because your lease term has shortened, your reductions on your Schedule 9 are not going to match up with your reductions on your Schedule 1. So you'll get a yellow flag in your annual report. So remember, a yellow flag means you can still file your report. It's not going to prevent you from filing. It's just a double check, a point for you to pause and say, okay, is this really correct here? And in the case of your leases, when you reduce the lease term, you can just verify your calculation, make sure it's correct. But your auditor is definitely going to ask you about that yellow flag. So make sure you document your calculation and you can explain to them why there's that variation. So lastly, we'll take a look at the excavator. On this slide, we hid the building and copier lease lines just to give us a little more space on the slide. So this time for the excavator, there's no change to our lease term, so we leave our due date alone. But now that we're going to buy the excavator, it's an installment purchase instead of a lease. So that means we need to change that ID number, and we need to get rid of everything that's reported on the 263.57 line, because that's a lease liability line, and it's no longer a lease liability. It's an installment purchase. So we use the ID 263.52. So to get rid of that lease liability, we put 48,000 in the reduction column just to get that ending balance down to 0. And now we need to get that balance onto the installment purchase line. And here the addition is 51,000. And that's more than we reduced our lease liability by. But if you remember back to our original example, the excavator could be purchased for an additional payment of $3,000. And now that the government plans to exercise that option and they're going to buy the excavator, they're going to pay that $3,000. So it needs to be added to their installment purchase liability. So that total addition is the $48,000 of monthly payments left and the $3,000 purchase price that the government is going to pay. And then the reductions there, that's just our 12 monthly payments of $2,000. And now our ending installment sale liability is $27,000, which is just our last year of monthly payments, plus that $3,000 we're going to pay to purchase that excavator. So we did not show you the BAR's payment for coding for your Schedule 1 here, but I just want to remind you that once your government decides they're going to exercise that purchase option, you should be using a 594 code, which is your capital expenditure code for the monthly payments, instead of that 591 code, which is a debt service code that you use when you're making lease payments. I'm sure many of you are wondering what your auditor is going to want. This is not a complete list, but it does include some of the basic things that auditors look for when a new accounting standard is implemented. So the first is documentation of your system of accounting and controls. So that means you should be able to tell your auditor how you know that your lease information is accounted for and reported correctly, and you should be able to have some documentation to show them and back up what you're saying. They're also going to want your implementation plan. So document what steps you plan to take, write down when you complete them, and take any notes on any obstacles or additional things that you do. And hopefully part of that implementation plan is documenting a complete population of all of your government's leases. So the auditor is definitely going to want to look at that. And this list shouldn't only include things that you determine are leases, but your list should also include any contracts or agreements that you analyzed and determined are not leases, because that's going to show your auditor that you looked at the full population and properly analyzed them. So write down your rationale for the items that you say are not leases and keep that for your auditor. Your auditor might also consider reviewing a vendor activity report to identify potential leases. And this is actually a step that you could also take pre-audit. So you could run a vendor activity report to identify vendors that your government is paying monthly or regularly. And then if you do see that your government is paying someone like monthly for a capital asset, like a building or a vehicle, you should really consider if that arrangement is a lease or an installment purchase. And then your auditor is also going to double check your figures reported on the Schedule 9. So have your lease calculations ready, your installment purchase calculations ready, and have that supporting lease agreement so your auditor can tie it back to that original documentation. And then also just document or highlight those important lease terms and how you decided whether or not to include options to extend or terminate in your lease term. And the last thing here is your note disclosures. So they're going to tie out the important terms in that table of future lease payments. So you want to make that easy to trace out, not only for your auditor, but also for yourself so that you can do it again next year. Okay, so now it's time to get started. You should be ready to implement leases on January 1st, 2022. So you have a little under 5 months. You'll need to be ready to start coding your lease payments properly and get ready to figure out those beginning balances to report on your Schedule 9. So here's a list of some things to help you get started. So the first one here is read GASB 87. So I know you all are cash basis, but when SAO writes the BARS manual for cash, we keep most of the concepts between cash and GAAP comparable. So reading this will give you a better understanding of leases. And then think about your system and controls. What needs to be updated so you can capture all of your lease information to make sure it's reported properly? And then again, make an inventory of all your leases. And this is probably going to involve working with other departments. So at the beginning of implementing leases and throughout the year, how are you going to get the information you need to the finance department from all of your other departments to make sure that you're including all the leases and calculating that stuff correctly? And then also document. So all of the key provisions of your lease terms, any extensions, termination options, what's the payment amount, any of those really significant contract terms, you should be able to access those pretty easily. And then start testing. You don't have to wait until 2022 to get started on this. And I highly recommend getting started early. So start running the numbers now, start looking at your contracts, and that will give you plenty of time to reach out to us, ask questions, submit help desks, and help make sure you're in a really good starting spot and have things accurately reported for next year.
Okay, here is the last of our code words. Code word number 4 is summer. And remember, you have to respond to the survey and list these words in order. So the last one is summer.
Okay, we are at the end of our presentation. We have a few minutes here for questions. As Christy said, any questions that we're not able to answer right away, we will send you an email afterwards and make sure that we do get those questions answered. So Christy, at this point, do we have any questions?
Yes, we do. There's one that has multiple questions on the same thing, so I do want to make sure that we get it covered. And that is on the example about the county leasing land to a farmer. Since the county is receiving revenue for that lease, would we expect that to be reported on the Schedule 9, which is the schedule of long-term liabilities?
Great question. So when we're talking about the Schedule 9, which is our schedule of liabilities, you're only reporting things on there if you're the lessee, meaning you're leasing something from someone else because you have future lease payments or lease liability that you have to pay out. But as the lessor, where you're only receiving money in, you don't have a liability. So you as the lessor, you don't have to report anything on your Schedule 9.
Perfect. Thank you. That cleared up a whole bunch of questions for us. Another quick one is for GAAP basis governments, there is an interest component in payments. Is that being completely skipped for cash basis governments?
Yes, all the cash basis governments can rejoice. You do not have to worry about an interest rate. So when we talk about your lease liability, you're just reporting the total amount of your future lease payments. You don't have to worry about figuring out what's the interest rate or the present value or any of that other stuff that is applicable for GAAP governments. So lease accounting for you really is quite a bit easier than it is for our GAAP governments.
Perfect. Another question is, how do we handle CPI on our lease payments? And CPI is Consumer Price Index and the changes of that.
So for CPI, what you're going to do is at the beginning, when you calculate your lease liability, you'll take a look at the CPI and factor that into your calculations for your total lease payments you're going to make. And for this one, so if there's changes in the CPI, you do not have to remeasure your lease liability every year. So you only have to do it once at the beginning when you're calculating your total lease liability.
Perfect, thank you. If we have the option to buy but aren't planning to buy, would we use the 591 or the 594?
Great question. If you have the option to buy, but you're not going to do that, you're not going to purchase it, treat it like a lease. So use the 591 code, and then on your schedule of liabilities, make sure you use the lease codes and not the installment purchase codes.
Perfect. For recording on Schedule 9, do we add the beginning lease as a beginning balance for the beginning of the year, or do we show them as additions in the year?
Great question. So if you have a lease that exists as of January 1, 2022, which is when lease accounting becomes effective, on your Schedule 9, you should have an increase in that beginning balance amount. So again, I know that your Schedule 9 compares your beginning balances to your prior year's ending balances. So you'll get a little yellow flag that says, hey, those don't match. Are you sure this is correct? And again, that yellow flag will not prevent you from filing. It's just a checkpoint for you to say, okay, does everything else match? And if your only variance is due to the lease implementation, that's okay. And your auditors are expecting that. So just make sure you have your lease calculations set aside for them to review.
Thank you. Would a contract for water rates be considered a lease and need to be reported on Schedule 9?
Deb, can you jump in on this one?
That was what, water rights?
Mm-hmm.
Yeah, I think, yeah, water and electricity and anything things like that are not leases, not considered leases.
Thank you, Deb.
If you have a copier lease with maintenance and supplies included, do you exclude the maintenance and supplies from your payments for Schedule 9?
Yeah, so if you know if that maintenance and supplies are like listed separately in your contract and you know what that amount is, don't report that as a lease liability. And as you make the payments related to those supplies, don't use your 591 code for that. Just use your regular functional expense codes for those types of additional items.
Thank you. Another one that seems to be popular is if a government contracts for portable toilets for a few months during a busy season, then they are taken back until the next year for the same season again. Would that be a lease?
So it depends on the contract. So if you have a contract that says we'll lease this for 3 months and then we're done, and then the next year you write a whole brand new contract that says, okay, we'll lease it again for 3 months, then that's a short-term lease and you don't have to report it on your Schedule 9. But if you have a contract for portable toilets, that's a 5-year contract, and it says in the contract you only lease those portable toilets for the 3 months each summer, then that is not a short-term lease because it covers the 5-year period. And remember from Deb's example, the control of the asset does not have to be uninterrupted. So the fact that you only use it for a few months out of the year wouldn't make a difference in determining that lease term.
Thank you. And one quick question, because I know this is huge, even though it's 11. Are governments allowed to make a threshold similar to the capitalization thresholds for leases?
So you can make a threshold for lease liabilities, but I do want to put a caution here that you really need to make sure that whatever threshold you put out there is small enough that all of your leases in aggregate that are excluded from being reported are not going to be significant to your government. And you'll have to do some sort of analysis and document those leases that you're excluding. That way, when your auditor comes to audit you, they can review your documentation and agree with your conclusion that the threshold you've set for your government is in fact low enough to make sure that there's not any significant errors in your Schedule 9 by excluding those items.
Perfect. Thank you. We are out of time today. Again, if your question did not get answered, we will send an email reply as soon as we can. And this session will be recorded and posted on our website. Thank you all for attending and have a great day.
Thanks, everyone. Bye.